Hello everyone, welcome to week 5 lecture video. So today's topic is credit risk. We will be covering two chapters today, chapter 10 and chapter 11. In chapter 10, we will be concentrating on individual loan risk, whereas chapter 11 will be focusing on portfolio loan risk. So first of all, what do we mean by credit risk? If I can remind you from week 1, credit risk arises because of the possibility that promised cash flows on financial claims held by financial institutions such as loans or bonds will not be paid in full. Virtually all types of financial institutions face this risk because all financial institutions perform one major function is lending money, and as far as lending money is concerned, there is always a potential that this money might not be paid back by the borrower, so credit risk arises. However, in general, financial institutions that make loans or buy bonds with long-term maturities are more exposed to the credit risk than are financial institutions that make loans or buy bonds with short maturities, which means that, for example, banks, building societies, credit unions, life insurance companies are more exposed to credit risk. Then the money market mutual funds or general insurance companies exposure to credit risk. Now, an overview of this chapter, although you will see a long list of learning objectives in the next two slides. However, I would say that we have two major agenda in this chapter. First of all, we will be talking about different types and characteristics of loan provided by financial institutions, and then we will discuss different models to measure credit risk. Okay, and don't forget that we are talking about credit risk associated with individual borrower. So let's come to types of loan. So in this topic, we will be mostly talk about, obviously briefly, different types of loans provided by financial institutions and their characteristics. First of all, business loans can be made for short term or can be long term. When we say short term, it can be as short as few days to few weeks. And when we say long term, it can be as long as 10 years or more. Traditionally, short-term business loans are used by firms to finance their working capital and other short-term financing needs. On the other hand, long-term business loans are used to finance the credit needs that extend beyond 1 year, such as the purchase of real assets, for example, land, building, machineries, and new ventures, or permanent increase in working capital. Okay, then a loan can be a syndicated loan. Large business loans nowadays are typically syndicated loan. A syndicated loan is provided by a group of financial institutions as opposed to a single lender. So a syndicated loan is structured by a lead financial institutions, which is known as agent, and the borrower. Once the terms of the loan, for example, rates, fees, loan covenants are set, the pieces of the loan are sold to other financial institutions. This means that investors can buy loans from the financial institutions involved in the original lending setting. Okay, loans also can be spot loans and loan commitments. So when a loan is a spot loan, it is made by financial institutions and the borrower uses or draws down the entire loan amount immediately. On the other hand, in a loan commitment, this is also known as line of credit. The lender makes an amount of credit available to the borrower, for example, $10 million, and the borrower has the option to draw down any amount up to the $10 million at any time over the commitment period. In a fixed rate loan commitment, the interest rate to be paid on any drawdown is established when the loan commitment contract originates. On the other hand, in a floating rate commitment, the borrower pays the loan rate in force when the loan is actually drawn down. Okay. And loans also can be secured and unsecured loan. A secured loan, this is also known as asset-backed loan, is backed by specific assets of the borrower. Therefore, if the borrower defaults, the lender has the first claim on those assets. Okay, an example is a loan made allowing a firm to buy a commercial building. In the event of default, the lender has a specific claim over the commercial building, and the lender can then sell the building to pay amount outstanding on the loan. An unsecured loan, on the other hand, is a loan that has only a general claim to the assets of the borrower if default occurs. Okay. Now, just to add a couple of more points, business loans are nowadays declining in importance in bank loan portfolios. The major reason for this has been the rise in non-bank loan substitutes, for example, corporate bonds and also commercial paper. Commercial paper is an unsecured short-term debt instrument issued by corporations either directly or via an underwriter to purchasers in the financial market, such as money market managed funds or superannuation funds. A corporate bond, all of you know, is a debt security issued by a corporation and sold to investors. The backing for the bond is usually the payment ability of the company, that is money earned from future operations. In some cases, the company's physical assets may be used as collateral for issuing bonds. Then come to real estate loan. Real estate loans are primarily mortgage loans. These real estate loans or housing loans play an important role in the Australian banking and lending markets. At March 24, building loans or housing loans represented 53% of all bank lending. These loans are typically a simple principal and interest or a reducible loan made to individuals and families for the purchase of the family home. These mortgage products typically require that interest and principal be paid back over some substantial loan period, such as 25 years or sometimes even more. Consumer loans, another major type of loan is the consumer or individual loan. Many financial institutions, including banks, finance companies, retailers, building societies, credit unions, offer personal loans. In addition, the same financial institutions provide consumer loan financing through credit cards such as Visa, MasterCards, proprietary credit cards issued by different companies. Credit cards play an important role in funding household expenditure and represented 40% of the personal lending by banks in the middle of this decade. The debt provided by credit cards are called revolving debt. With a revolving loan, the borrower has a credit line on which to draw as well as to repay up to some maximum over the line of the credit contract. The other large class of loans is non-revolving personal loan, which include new and used lines of credit, car loans, fixed-term consumer loans, such as 24 months loans. In recent years, banks have normally faced higher default rates on their credit card outstanding than they have for personal loans, rates that are also significantly higher than those business loans. Such relatively high default rates against point to the importance of risk evaluation prior to making the credit decision. There are other forms of loans also provided by financial institutions. For example, farms loan, other banks, non-bank financial institutions such as broker margin loans, and also loan provided by foreign banks, loans provided by state and local governments, etc. Now, how do we calculate rate of return on a loan? Look, an important element in the credit management process once the decision to make a loan has been made is its pricing. This includes adjustments for the perceived credit risk or default risk of the borrower, as well as any fees and collateral backing the loan. Okay. Um, Actually, a number of factors impact the promised return and financial institution achieve on any given dollar loan amount. These factors actually includes interest rate, fees, credit risk premium, collateral, and other non-price terms such as compensating balance, reserve requirements, and so on. Um, just a couple of points. First of all, these return calculation will include fees, typically a loan origination fee. Loan origination fee is charged to the borrower for processing the application, and interest rate typically include a base rate and a plus a credit risk premium. Base rate is called prime rate, or the lowest rate charged to the most creditworthy borrower. Then a credit risk premium is added based on the creditworthiness of the borrower. For example, when a borrower is highly creditworthy, then a low credit risk premium will be charged, or the loan will be provided at a base rate. On the other hand, if a borrower is less creditworthy, a sizable credit risk premium will be added with the base rate. Compensating balance is a percentage of a loan that a borrower cannot actively use for expenditures. Instead, this balance must be kept on deposit at the financial institutions. For example, a borrower facing a 10% compensating balance requirement on a $100 loan would have to place a $10 on deposit with the financial institutions and could use only $90 of the $100 borrowed. This requirement raises the effective cost of loans for the borrower, since less than the full amount can actively be used by the borrowers, and the deposit rate earned on the compensating balance is less than the borrowing rate. Thus, compensating balance requirement act as an additional source of return on lending for a financial institutions. A reserve requirement also matters when we are calculating the rate of return on a loan. A reserve requirement imposed by the central bank on the financial institutions. So which means that a reserve when there is a reserve requirement, then for any deposit, a certain amount of the deposit must be kept with the central bank. Now, the rate of return is calculated using this formula. So you can see the K is the rate of return we are talking about. Then 1 plus F, which is the loan origination fee. BR is the base rate. This is credit risk premium I was talking about. Divided by 1 minus B is the compensating balance, and RR is the reserve requirement. Another point quickly is this is expected rate of return, and this is equal to promised rate of return, or the contractually agreed rate of return. Now, one point you need to remember that if there is no default risk, and the probability of payment equals to 1, in that case, the expected rate of return and promised rate of return will be same. For example, if you calculate that contractually agreed return is 10%, the expected rate of return will also be 10% if there is no default risk. On the other hand, if there is a default risk, that means probability of payment P is less than 1, then the expected return and the actually promised rate of return might be different. Retail versus the wholesale credit decision. Because of there is small dollar size in the context of a financial institution's overall investment portfolio and higher cost of collecting information on household borrowers, most loan decision about the retail loan made tend to be a binary decision. So binary decision means most of the retail loan decision is taken as accept the loan proposal or reject the loan proposal. All borrowers who are accepted are often charged the same rate of interest, by implication, the same credit risk premium. For example, a wealthy individual borrowing from a credit union to finance the purchase of a Porsche is likely to be charged the same car loan rate as a less wealthy individual borrowing from the credit union to finance the purchase of a Hyundai. In the terminology of finance, retail customers, consumers loan and small business loans are more likely to be sorted or rationed by loan quantity restriction than by price or interest rate difference. That is, at the retail level, and financial institution controls its credit risk by credit rationing rather than by using a range of interest rates or prices. In contrast to the retail consumers at the wholesale or large business loan level, the financial institutions use both interest rates and credit quantity to control credit risk. Thus, when financial institutions quote a prime or other base lending rate to business borrowers, low risk borrowers may charge a lending rate below or close to the prime lending rate. Higher risk borrowers are charged a markup on the prime rate or a credit risk premium to compensate the financial institutions for the additional credit risk involved. So that's all of our discussion about different types of loans and their characteristics. In the next video, we will be talking about different models to measure credit risk. Thank you very much.